soon too. So I'm gonna turn it over to him, and I'm gonna record this as well and share it with y'all afterwards. So if there's any questions that y'all may miss, or with note takings, you can always come back and do that again. So we're gonna turn it over to Mike, and he's gonna tell you about himself, and we'll go from there.
All right, joining us on this Friday evening. I know it's Friday night, but it's quarantine time. There's not much to do anyway. So just wanted to take a couple minutes of everybody's time, introduce myself, tell you a little bit more about who I am, what I do. Born and raised in Houston, Texas, but I currently live in Arizona. I came out here to go to school. Had the athletic background, played professional sports for a short period of time, got into the corporate world like very many of you. But I got tired of it. I got over it. I was tired of putting my mask on, 9 to 5, wear your suit and tie and be someone else. And during this entire time, I've always coached. I work with kids as well. Like I said, I have a passion for helping other people. I have a passion for helping the younger generation. I like to teach those lessons that I always wish I was taught when I was a kid. So that's kind of how I got into the mortgage business. Got to meet a lot of people, build a lot of relationships. And now my manager, who I worked with his son for 2 years, is my boss. So I've been in the mortgage business for going on 4 years now. I'm a licensed loan officer in 18 states. Texas is, of course, one of my bigger states because that's home for me. And I feel like I speak the language. I can connect with people. And then on the other side, the obvious part is there's not very many African-American mortgage lenders out there. You might see realtors, but on the financial side, there's not many. So I always like to feel like I'm there to reach out. I want to be a resource for everyone. When people have questions, when they want to get their ducks in a row, when they want to know how the process works to purchase a home, I want to make sure people feel comfortable to reach out to me. I always like to share my contact information. There's no such thing as a stupid question. And then, like I mentioned it before, I have a passion for helping people. So on the mortgage side, purchasing a home, as you all may know, is one of the largest investments you'll ever make in your life. And my job is to give you some peace of mind, some confidence, because purchasing a house can be stressful. There's a lot of terminology that you may not even understand, know what it means. It could be scary. But again, I encourage people to ask a lot of questions. Don't feel like you're bothering me. Let's enjoy this process. This is a very exciting process, especially purchasing a home. But we got to do the financial part first. So there's a number of guidelines that the Federal Reserve, they put in place. They change rules all the time without announcing them. But again, that's my job to help you get yourself to the finish line and achieve your goals and find out what your motivation is so we can lean on that to get you to the finish line and become homeowners. So I love doing my job. It's very fulfilling. I love seeing people achieve their goal, getting their first house or investment properties in a lot of your cases, which I'm in the process of purchasing multiple homes as well, just to build that long-term wealth, show the next generation that there's more ways to be successful than just going to work 9 to 5 and getting your little $1,500 paycheck. So that's what I'm all about. I'm all about supporting my community. I'm all about giving back. I'm passionate about it. I enjoy it. I will do this probably the rest of my life. And I'm glad to sit here in front of you all just to be a resource to everyone. Like we connected with Ms. Espinoza, and I feel like we clicked. And she mentioned that she had a group of people that may have a lot of questions and may need some guidance on where to start. And that's what I'm here for. So would love to open it up to any questions you may have. There's no such thing as a stupid question, though, so don't feel like you're getting embarrassed. I'm an open book, so if you need anything during this time or even at a later date, you can share my contact information, open up the line of communication, call, text, email, social media, whatever you need to get some peace of mind to achieve your goal of becoming a homeowner. I'm here to help. You're muted.
Feel free to unmute yourself like I didn't do and ask him questions and stuff. I know that I have some questions that were emailed to me. A few of the questions, and this may be, is like, what credit score do I need in order to purchase a home?
Great question. So there are 2 answers to that question. Pre-pandemic, you need at least a 580 to be eligible. And when I say eligible, that means you can sit at the table. Doesn't mean you're going to qualify or get approved, but you have at least have to have a 580. But I have noticed that has slightly changed over the past 6 to 8 months because of the pandemic. And the Federal Reserve, it's been difficult to get an approval for anything less than 630. Anytime you have lower credit scores, you have to offset it somehow. And when I say offset it, I mean have additional assets, have a low debt to income ratio, something to show that you are a low risk, because on paper, the credit score is the very first thing that any underwriter, any investor, anyone will look at. They want to see what your history looks like, what your credit history looks like, how responsible are you? So if you have a lower credit score, but you have a good down payment, then it offsets, then you'd be in a good position versus having a low credit score and low down payment. It's very difficult to get an approval. Does that make sense?
Yep. So 630 pretty much will keep you in a safe place. The second question that I have is, how much money will I need for down payment and closing?
One other thing, I want to ask that last question, because
Okay.
A lot of people have questions about what credit score do you use? How many credit scores do you pull? Where do you get your credit scores from?
Mm-hmm.
I can't tell you. A lot of people will call and say, well, my credit on Credit Karma is 750. Credit Karma is a very consumer-friendly credit reporting system. They focus on different things. They may look at how much credit cards you have, how much debt you have, how long have you had this debt, et cetera, et cetera. And I'm not a credit specialist, but I've seen a lot of credit reports and know enough to know that Credit Karma, kind of take it with a grain of salt. It does help show that there is some transaction, there's some improvements in your scores, but when you go to purchase a home, it's a lot different. We do a tri-merge credit report, which means we pull all 3 scores from all 3 bureaus. And by law, we have to use your middle score. So if you're at a 600, a 650, and a 700, your credit score will be a 650 for the loan. But let's say you want to purchase a home with your mom, your brother, siblings, friends, cousins, other family members, or friends, then whoever has the lowest score, we have to use their scores. So if mom had 700, 701, 702, but her son, as a co-signer on the loan, has 600, 601, 602, the whole loan gets a 601 credit score because that's the lowest score's middle score. So hopefully that answers some questions, because people will ask, well, Credit Karma shows me 700, Mike, but you showed me 620. What's going on? You're not doing your job. I just want to make sure that that's clear up front so there's no surprises.
That's good information.
I think you have a question.
Yes, I said, how does that help if they would use the least credit score from?
It doesn't help. It's all about worst case scenario, because it's the government. They make these rules. They want to make sure that worst case scenario is still good enough to qualify. We know the person with high scores is responsible, but what about this other person? Is that person going to ruin the whole loan? Are they going to default and make the whole loan blow up? So they have to go off that person's score to get the approval.
So here's did anybody else have a question? I'm sorry.
I have a couple of questions.
Okay.
High score with derogatories. How does that impact a loan? In particular, investment loan.
Great question. So depending on what type of derogatory credit we're talking about, I mean, if it's potentially student loans, if it's collection, medical, a lot of different types of loans. When it comes to medical, I exclude. No matter what, I exclude. Because some people say, well, my medical bills are messing up my credit. Yes, that happens to a lot of us. I'm kind of one of them because I'm coming off of a torn Achilles. So I got medical bills too. But in the approval process, I exclude it. But at the same time, it still affects your credit score. So the credit is one thing. Student loans in collection, depending on the type of loan. Most of the time you mentioned investment. Investment properties are always conventional loans. FHAs don't allow it. VA don't allow it. USDA, they don't allow it. Only conventional loans. So as long as your debt to income ratio is still below the limit with the derogatory credit, you can still potentially qualify. But if you have like student loans in collection, and may have to hit you for additional percentages towards your debt to income ratio, which ultimately increases it, which will affect the qualifying process. Does that make sense? Did I answer that
Yes.
question? Okay.
Mhm.
And you had a second question.
Then the second one, I wasn't aware I had this question until you mentioned group loans, where you take the lowest score. So again, as an investor, I would be interested in understanding, how that works, and to have more than like if two folks want to, partner up and get a loan to purchase property. You're saying then that's something that is done. So I could partner up with Obed Joe over there, and together qualify for a property that I wouldn't necessarily be able to qualify for based on income, my own income.
Correct.
So
Great question.
Combine that.
Yeah, I'm glad you brought that up. So just to kind of explain the process of adding two people versus one. Two people look better on paper. It helps the overall approval process. Two incomes look better than one. So it helps you get a little bit more purchase power and lowers your debt to income ratio. But the negatives are two people add more liabilities. That's more debt depending on what your situation is. Also, two people, if one has a lower score and one has a higher score, the lower score is kind of steering and quarterbacking the entire loan. So those are two things that I tell people to think about. If you want to co-sign or team up or partner with someone and purchase investment properties, discuss where you are in your financial process, because when you start the process, then those are the numbers that we have to use. And if we want to use additional information, we have to re-pull credit again, or we can delay the process, work on XYZ, pull credit again, so you're both up at the highest point you could possibly meet, just so the approval process is a lot smoother.
And I would say the first thing is to make sure that you partner with someone that you can rely on to make their part of it. Because then if the loan goes south, then so does your credit, right?
Exactly. Okay. Good point. Great point. Because yes, if the loan goes south, both parties are affected. So have that conversation. Find out how strong their income looks like. Do you plan on being at this job? Is your income going to be consistent? Because that's what I also do. I have to find out what your ability to repay is. So that's why I do all my calculations when it comes to income. My team reaches out to your employers to get verification of employment so we can source what's on your pay stubs. Again, so there's no surprises and you have some peace of mind to start the fun part of looking for the home.
Okay.
Any other questions? So here's the second question that I received. If I'm married and I want to purchase a home, do I have to use my spouse's information if we're separated?
Ooh, that's a great question. Everyone's located in Texas, is that correct?
Yeah, community, yep.
There you go. She said it. So Texas is a community property state. And what that means is all government loans, FHA, VA, USDA, we have to take the spouse's liabilities into consideration. No matter what, no matter if you say, well, we're separated, we don't live in the same house, we're going through a divorce, I don't talk to that person. It does not matter. As long as you are documented married, we have to take the spouse's liabilities into consideration. And when I say that is, you fill out an application, we pull credit, and you only have one credit card and a car, and you pay $200 a month for both, let's say. And then we have to do an FHA loan. Then I'm gonna come to you and say, okay, well, I need your spouse's full name, social security, date of birth, contact information, so I can pull credit on your spouse, import their liabilities, and then add their liabilities to the loan and calculate the debt to income ratio. So if they have a lot of liabilities and a lot of debt, of course, it's going to increase your debt to income ratio and risk the chances of getting it approved. So that's why I say on all government loans, it's a requirement. There's no way around it. Conventional loans, you don't have to. But the only thing about conventional loans is your spouse has to sign a disclaimer deed the day of closing. Just so you can't go out and buy a house and your spouse not know. It's against the law. So they have to know something. So the day of closing, they have to sign and be okay with signing a disclaimer deed, because if not, it'll hold up funding. And I've experienced that one time, and it's not pretty.
Okay, and that's with conventional. Conventional, you could possibly get the home without the spouse, but FHA, they want everything. Government wants everything.
That's the government, everything.
And what happens, and the thing about that, when I know by going to closing, is that when you get the title pulls everything. So if you think they're not going to find out, they're going to bring out a whole list and say, who is this person? Who is this person? So and then once you get to that table, the last thing you want them to do is say, well, we have something here and we need an affidavit for this, or we're not going to be able to do this. So now everything is put on hold or canceled, and now you've lost your option money and all that other stuff. So we don't want to do that either when it comes to purchasing a home. Anybody have?
I want to piggyback off of what you just mentioned. That I encourage people, initial conversation, as a lender and the borrower, the buyer, we're on the same team. So I encourage people just to feel comfortable, open up. I need to know we're on the same team. If there's something that you don't tell me that pops up later and I can't find a solution, then everything goes sour. It goes left. A lot of interested parties are upset, and they blame me, of course, because I didn't find out that information. So I always tell people, feel comfortable. Let's be transparent. Let's communicate, because my job is to make everything look good on paper. And if it doesn't, I have to find a way to find a solution for it, so I'm prepared for it. So again, you go out and buy a house or get excited to purchase a home, but you didn't tell me about X over here. That's that black cloud hanging over us. When we get into processing and my processor and title starts digging, they're going to come to me and say, Mike, did you talk to her about XYZ? Who is this person on this? What's this fraud report all about at this address? And then I got to come to you and say, okay, what is this? And it's not a great conversation to have. So always just be transparent. Let's have the uncomfortable conversations up front so we can, again, enjoy the process.
Right. Yeah. Someone have a question?
Yes, I have a question. So can we talk about some of the non-traditional routes to funding? I know that people like Dave Ramsey, other people like that don't. So I've been a business owner for 6 years, and as I get ready to prepare for a house, my goal as a business owner is always to claim as many deductions and tax exemptions as I can, right? Because I want to keep that balance low so that I can pay less taxes, right?
Right.
So in doing so, and trying to keep that income to tax ratio down, but still qualify for a house. I know I've heard of some non-traditional, some other types of underwriting that you can do if you have a certain amount of cash, if you have a certain amount of debt to income ratio. So can you talk a little bit about that?
Absolutely. So just to hit one thing, self-employed buyers, self-employed borrowers are one of the most difficult things to qualify these days, because the Federal Reserve, they put additional guidelines this year. And when I say that is there's additional documents like tax returns for the past 2 years, those no matter what, business tax returns for the past 2 years, personal and business bank statements from the past 60 days, profit and loss statements from the first of the year through, if we were doing it alone today, through November 30th. All that information has to match, and all has to match what you put on the application. But you mentioned non-traditional. There's bank statement loans. Bank statement loans are for borrowers that are earning a large sum of money each month that may not have the consistent income at a self-employed job or a 9-to-5 job that most people have. It's more variable income from multiple sources. So there's bank statement loans out there, but bank statement loans require 24 months of bank statements. So there could be a lot of stuff on there, large deposits, some suspicious activity. Again, you got to have those conversations up front so there's no surprises. There's also ways to do Jumbo loans. Jumbo loans are another popular thing for self-employed borrowers. Self-employed borrowers usually have a little bit more assets up front that they can put down for down payment or closing costs as well. So those non-traditional loans, I have to be honest, they've kind of slowly faded away because it's a higher risk. Rates aren't as great. It's a longer process. It's a deeper dive into personal information and more money up front. So I have to be completely honest. I don't do a lot of those. I've only done 2 jumbo loans this year. I've only worked with, I probably say, a dozen self-employed borrowers, because once I have the conversation and tell them I need all this information, it gets kind of discouraging. So I tell people, what's the goal? Focus on the motivation. Focus on the goal. Get me this stuff. Let me do all the hard part again so you can start the process. But again, self-employed borrowers have to have those tax information. But if you are owned the property, or I'm sorry, not owned the property, if you have owned a business or have been self-employed for at least 5 years, I only need to use 1 year of tax return income. But if it's less than 5 years, I have to average the past.
So I'm saying my personal business accounts or my income accounts are fine. Okay. But, as far as, the business, my goal is to keep my expenses high, right?
Right, exactly.
So yeah, but the business has been in tax since, for over 5 years. So
then that's good. But one other thing you have to keep in mind is the qualifying part, the qualified income that I can use, because you may bring home $100,000, but on paper you bring $20,000.
So I'm saying my personal income. So the business and my personal is separate, right? Oh, okay. So what the business brings in and what I bring in is going to be different. I'm saying I can verify what I bring in via bank statements, but the business, when I claim my business on my taxes, well, I'm going to say my income and my expenses are closer.
Right.
Than my personal income.
Any of those losses, that's all the information that's going to be on your tax returns. Any of those losses, I have to consider those. I have to use those in my calculations, because if you have a lot of expenses and the income wasn't that great that month, those are losses. And obviously, I can do that over for 12 months on top of your personal income and just make sure all the calculations are correct before you get an approval.
Sure. Have you heard of these underwriting loans that certain banks do for people who put large deposits down?
I've heard of them. I'm not too educated on them. I have to admit, I've heard of them. Okay. They're not as common.
Because they're specific to a bank, and the banks are underwriting the loans for the individuals because they know their track record, right? Exactly.
Usually private lenders do it. Specific banks, big banks like U.S. Bank does it. They do all the jumbo loans, I feel like, these days. So it's all about finding the right fit, finding the right bank or person that has your best interests. Because I have to admit, when you're dealing with those type of loans, it's more upfront money. Higher risk.
Yeah.
So you have to just be prepared and have work with someone.
Yeah, no worries. Thank you.
Absolutely. Any other questions? You're muted.
I need to give you the control. I'm sorry. I have a second question here. And this is from someone. It says, can we start the process now in order to know if we can be approved before you find a house? She wants to know how soon do they need to start the process in order to know how much they qualify for before they're purchasing a home. So if they're not looking to move for, like, say that they're leasing and their lease is up in February or March, how early should they start looking for the loan?
Honestly, I tell people, as soon as you start thinking about buying a house, get the pre-qualification process started. Because what if something is standing in the way and your lease ends in February, but you may not be able to purchase a home for 3 or 4 months, but you in your mind, you're telling yourself, I'm gonna go purchase a house when my lease is up, but you may not qualify. So as soon as you start thinking about it, start the pre-qualification process. Because if you qualify, great, get that off your back. I'm in good standings, I just have to maintain or improve my situation. But if you don't qualify, then we have to work on some things, and those things could potentially take 30, 60, 90 days, who knows? But if you don't address it or find out, it'll put you in a rough spot where either you're going to lose the place you live in, you're going to be homeless, you got to extend the lease, your rent's going to go up, you got to do it month to month. The flexibility is not going to be there. Then you're scrambling and stressed trying to get qualified at the same time while you're renting.
Does doing pre-qualification affect my credit, make it go down or up if I'm looking for a home?
Great question. So that's one of the most common questions. I will have to pull credit, and it will be an inquiry, but it won't be an inquiry like applying for a credit card or an auto loan where it just dings your credit and knocks it down 20 points. Pulling credit for a mortgage is a lot less aggressive, I should say. But at the same time, depending on what you see on your end, because if you see Credit Karma telling you 750 and we go through the pre-qualification process and I pull 680, you're going to tell me that it took your credit down 80 for that 70 points, where it really might hadn't done anything at all. It's just my algorithms and the type of FICO scores I use will be different than what you see. But to answer your question, it will be an inquiry, but not like an auto loan or credit card.
Okay, anybody else have a question?
Yes.
My man Obed has a question.
Okay.
Yes. What is a good debt to income ratio
Great question.
when you want to borrow?
Depending on the loan program, for conventional max debt to income ratio for a single family home as your primary residence is 50%. As an investment property, it's 45%. FHA loans, FHA has a debt to income ratio max of 57%. VA loans, there really isn't a debt to income ratio limit. I've been able to get people qualified with 62. Well, I think it was 65 was the highest. So it's hit or miss with VA. USDA, which is also very similar to VA loans, which is no down payment, they like to see 35% or less. Also, down payment assistance, depending on what type of program it is, they like to see very low debt to income ratio. We're talking 40 to 45%. And when you're looking at your liabilities, when you're trying to calculate your debt in your head, only use the liabilities on your credit report. So don't factor in your phone bills, don't factor in your utility bills. I'm talking only things like student loans, credit cards, mortgages, installment loans, anything that will be on your credit report. Those are the numbers that I have to use towards your debt to income ratio.
All right, and Mike, going back to that question, Taquita does have another question here. The down payment and the closing costs, or how much is it how much do you need for down payment and closing? And are there down payment assistant programs, and how do those work?
Perfect, great question. So as a first-time home buyer, the FHA, you can put as low as 3.5% down. Conventional, sometimes you can put as low as 3% down, but again, all the numbers have to calculate. If you're a veteran and you want to take advantage of your VA benefits, no down payment, one of my favorite loans, no down payment and no mortgage insurance. Also, USDA has a 0 down payment as well. Closing costs, like you mentioned, closing costs is one of the things that most first-time home buyers or home buyers in general, they forget about. Closing costs is just like taxes, because you see it all looks pretty, but when you get to the final table, the numbers go up. So I'll always tell people, be prepared for closing costs. And closing costs is the most difficult thing to know exactly how much it is. It's always an estimate, because closing costs is the cost of doing the loan. When I say that, you have to factor in title fees, insurance, property taxes, prepaids, depending on how many months that the title company will collect in property tax up front. Appraisal fees, which you actually pay up front, then we take it out of your closing costs. Credit report fees, underwriting fees, processing fees, origination fees. If there's HOAs, HOA fees. There's a lot of different fees that are added to closing costs. But if you had to give yourself some peace of mind, always factor in about 3 to 4% of the purchase price to go towards closing costs. Just to give you some peace of mind and prepare yourself for closing costs. But the good news about closing Closing costs can be paid by all interested parties. And when I say that, I mean the seller can pay closing costs. Even the realtors can contribute towards closing costs. Title can contribute towards closing costs. Us as the lender can contribute towards closing costs. Anybody and everybody can contribute towards closing costs. But again, depending on the type of loan program, will only allow you to request a certain amount from the sellers. Just real quick, FHA, you can request up to 6% from the sellers to go towards closing costs. Conventional is 3% from the sellers to go towards closing costs. VA is 4% from the seller towards closing costs. Second question, brought up down payment assistance. This is one of the ones that I experience every day. So down payment assistance, it sounds very attractive. Down payment assistance sounds like free money, but we all know there's no such thing as free money in this world. And they always with the catch. And depending on the specific programs, they may have a requirement that you have a certain credit score, the requirement that you get a slightly higher interest rate because that's how they make their money over time. You may have to stay in the home for a certain amount of years without refinancing or selling, because if you do one of those things, they'll hit you with a penalty. And it's usually the down payment you borrowed when you first purchased the home. It also comes with an additional origination fees, third-party fees that are added to your closing costs. So if your closing costs on a standard loan is like $10,000, down payment assistance may be anywhere from $11,000 to $12,000, depending on purchase price. So I always tell people, be prepared to ask questions if you're interested in down payment assistance. Tell them to explain it, because it's only for down payment, because there's still closing costs. And if you're not prepared to pay closing costs, then the whole loan doesn't make any sense. So as long as you're prepared for closing costs, because especially with this market these days, sellers ain't wanting to pay closing costs.
Yeah.
They can sell a house like that, or they get multiple offers left and right. And if you go and say, hey, Mr. Seller, I want to offer you full asking price, but can you pay my closing costs? They may laugh in your face. But if you're prepared for it, you can write a very competitive offer that they can't refuse. So hopefully that answers your question.
So if you have someone, a family member that is willing to assist you in your closing or down payment, is that allowed, or how does that work if you have someone? I know that someone's it's called gift money or whatever. I'm not sure exactly how that works, but if somebody is going to loan you money to close, can you how does that work?
Yeah, so gift funds. Gift funds can only come from family members. That's it. Can't come from someone that owes you money. Can't come from your neighbors. Can't come from your brother that you grew up with, sister that you grew up with. Not allowed. Has to come from family members. But depending on the loan program, depending on the qualification requirements, will allow you to use gift funds, because a lot of times, like Ms. Pace mentioned, she's looking to do investment properties. A lot of investment properties won't allow you to use gift funds. On investment properties, they're looking for reserves. When I say reserves, it's how much money you got in the bank after we close. How many months of reserves do you have? When I say that, let's say your monthly payment is $2,000. You have $4,000 in your account after we close. You only have 2 months. But my findings in the underwriter may say, no, only way to close this loan is if they have 6+ months of reserves. So those are some things you also have to think about when you're looking at investment properties, multifamily properties, second homes, or anything that you don't plan on making your primary residence.
Okay, thank you for that. Any other questions somebody have before I go on? No.
I was wondering about construction loans. Are you experienced in those? Can you tell me what are some of the common investor type loans? What do they typically use?
Great. Yeah, just to address that, I don't do construction loans. And the reason why I don't do them is because they are a nightmare for the buyer, for the lender, for everyone involved, because it's a lot more money up front. It's a longer process. You have to pull credit 2 or 3 times. Not a lot of lenders do them anymore. We actually discontinued them in our company starting this year, January 1st, because it's been a nightmare for people. So those are the common like 203K loans, or people will say a fixer-upper loan. So you qualify for 200,000, buy a house for 100 grand, and use 100 grand to make those repairs.
Right.
Again, I haven't touched them. I don't know a lot about them. All I've heard is they're a nightmare. Obviously, I got educated on them because you have to before the exam. All I know is it's a higher risk, more money up front, a longer process. But again, if you have a good team, if you connected with good lenders or private lenders that are willing to do it and answering all your questions and being very transparent and communicating, it's a great opportunity to build a home or design a home exactly the way you want it. So hopefully that answered your question.
All right. Any other questions? So I have another question here. Is purchasing a townhome or duplex under the same rule or guidelines as purchasing a single family home?
Incorrect. So it all comes down to the legal description of the property. So if you might look on Zillow and might say townhouse, row house, condo, single family home, it's not confirmed. Once we confirm it on the legal description, that will determine which route we go. So when you said a duplex is considered a multifamily home. Those are the properties that you have to put additional down payment on, unless it's an FHA approved multifamily home, which you have the opportunity to put as low as 3.5% down. If not, for multifamily homes, it's a minimum of 15% down. If you plan on purchasing a multifamily home that you don't plan on making a primary residence, it's a minimum of 25% down. So those are some things that can change with multifamily homes. Townhouses, it all depends, because townhouses may be defined as townhouse, but legal description may be condo. And when on all condos, most condos have HOAs or have to require a condo questionnaire, which will tell me what kind of liens or judgments the entire complex has. And if the complex is more than 15% delinquent, then it's not approved. We can't lend on it. We can't purchase it. And also, those condo questionnaires, the buyer has to pay for it up front. And it could be $200, $300, $400. And then once we get the condo questionnaire to find out if there's any delinquencies and judgments, et cetera, and we're approved, then we can move forward with the process of ordering the appraisal and things like that. But if the buyer buys the condo questionnaire and it comes back and says, well, this complex is 15 plus % delinquent and it's not approved, then the buyer is out of that money up front. So I always tell people, if it's a condo, hope you're in love with it and be prepared for that additional questionnaire fee up front before you pay the upfront fee to pay for the appraisal.
All right, I have another. Okay, go ahead, Obed. I'm sorry.
Yes, I want to know how do your second home factor into your loan application? Does it depend on how much you owe on your first loan?
Great question. So actually, I've run into that a lot these days, especially with refinancing, because refinancing has definitely been hot and people have those second HELOCs or those other second mortgages on your loan. So it does, we have to take that into consideration. I have to calculate what your payments are on that second to qualify, depending on what type of second. If it's a non-forgivable second, then we may have to address or pay it off before you can move forward. If it's a forgivable second and you've met the time or the stipulations that they require for it to forgive, then it's perfectly fine. I just have to factor into whatever your monthly payment is.
Yes, I own a home, a first home, and I want to purchase a second home.
Mm-hmm.
Now, my first home probably I owe like $40,000 on a $300,000 home.
Mm-hmm.
My question there is, does that $40,000 really affect if I want to get a second home?
No, your monthly payment. So you owe, let's say you bought that house several years ago and you pay $1,000 a month. Now you're down to $40,000 balance. I still have to hit you for that $1,000 a month. But also I have to hit you for if there's any HOA fees. I have to hit you for what the property taxes are. I also have to hit you for what the homeowner's insurance are. I have to factor all those things into my calculations. But also, let's say it's an investment property. You have tenants in that home with a fully executed lease agreement, I can use whatever that income is on your lease agreement, but only up to 75%. So if you make $1,000 a month in rental income, I can use $750 towards your income to offset any liabilities, lower that debt to income ratio.
I have a question from Karima. She was just, if you are purchasing a home and you're in the middle of the process and you switch jobs during the process, what happens at that point?
Ooh. Depending on what the income looks like. Because if the income doesn't change, let's say, okay, I'll give you an example. Let's say you pre-qualify and you're in the process and you're a salary employee. So you get paid the same every 2 weeks, which is very easy to do. And then you switch into a whole new line of business and you're getting paid hourly. Now your income is variable and I have to calculate it differently. Starting at a new job, new line of business, you have to be at that job, depending on loan program, for up to 60 days before you can qualify to close on that home. But let's say you're a salary employee and flip to another salary job, then I have to have at least one pay stub and a letter from your employer that shows that you are a salary employee, you make this much money, and that pay stub has to match that letter for us to close. But hopefully that answered your question. But a lot of times I tell people.
So if I'm hourly, I have to wait 60 days on the new job before I can do it. So the process stops. And then do you come back in and have to now pull credit again or do everything, or you just verify in the income?
Just verify income, depending on how long it takes, because the credit report lasts 120 days. And if we start the process early, then we still have some time. But if, let's say, you're out shopping for 3 months and we're on our last month to close the loan, once that 121st day comes, I will have to re-pull credit.
That's good to know. Go ahead, Obed.
Yes, sir.
Okay, let's go back to the second home. I have an opportunity to buy a home, but I was still owing, let's say, $40,000 on my present home, and I went and paid it off. Do I have to wait extra time before that it should be reflected on my credit before I get the second home?
No. So what we do is a credit supplement. So on your credit report, it might say you still have that balance on your credit report. But if you show that you paid it off, we ordered the payoff, you showed me receipt and paper trailed everything. My processing team, they do a credit supplement where they contact the bureaus, and the bureaus just take all that stuff off because we can source it. We have it. And we can get rid of that debt. But at the same time, when you're looking to purchase another home, I still have to hit you for that homeowner's insurance and property taxes and any HOAs on the home. But at least your monthly payment liability will go away, again, to give you a little bit more purchase power and lower debt to income ratio.
Any other questions? It's coming in. Mike, can you put in the chat or just tell them what your information is, your phone number, your email address, all the information so that they can have it, and I'll gather information and just share with you as well so we can all keep in touch. And yeah, and go from there and with the process. And one question that I had is, with everything virtual now, I was asking Mike, I'm like, so how do you work the process if you're not actually locally? You don't have to be local. He doesn't have to be here in order to process that loan and get the information to you. And he's able to do everything he needs to do from where he is. So you might explain that part too.
Yeah, like I mentioned earlier, I'm licensed in 18 states. So I work with people all over the country. To be honest, southern states are kind of my go-to because that's who I naturally am. Again, I speak the language. I feel like I connect with people. I feel like it starts with education, and I can only speak from my own experience and my own family. And purchasing a home is something that we aren't taught. We aren't educated on. We don't know where to start. We think we need 20% down. We think we need a 700 credit score. We think we need a certain amount of money. So I love to educate people because it starts with education. It starts with helping people out and showing you genuinely care, because I really enjoyed this job. And I've been able to connect with people in my own community just to support them and help them achieve their goals. Because again, there's no better feeling to seeing someone work so hard to get to the closing table, to find their first home, to purchase their first home. Because I know what that feels like. I was raised by a single mother, only child. I remember my mom got a good job when we moved to Sugar Land, Texas, bought our first house. I remember running upstairs trying to find out what room I have. And I get excited telling that story because I know what people on the other side are thinking. I know why they're purchasing a home. They need more space, growing family, start an investment, build foundation, things like that. And that motivates me to do my job again, so you can enjoy the process. But just to give you some contact information, I'm actually putting it in the chat also. But you can reach me, M Jones at Peoples with an S, mortgage.com. Mortgage has that silent T, people forget, including myself. Cell phone number is 832-646-9674. Don't feel like you're ever bothering me. If you ever have any quick questions, I'm a big texter. I ask my wife, I'm always on my phone. My phone's going off nonstop. But I multitask. I beat up my kids and help my clients out at the same time. So if you ever have any quick questions, please feel free to email me, text me. If you want to go into depth, let's talk on the phone. I'll always make time. I'm never too busy for referrals, especially during the process of purchasing a home. Also, I'm on social media, have Facebook. Obviously, I have the most common first and last name in the world, so good luck finding me, but I'm in there. And then Instagram also, Mortgage Mike Jones 1. I'm on there as well. I interact with a lot of people. You can see my family a lot. Big on sports. Like I said, I'm football and baseball background. And other than that,
I have one last question for you.
Go for it.
And because it kind of, how long does it take to close on a home?
Depends on who you're working with. With me, I average 26 days from offer accepted to close. Most lenders are 45 to 60 days, but I have a small group. We're a direct lender, which means we do everything in-house. I can yell and scream at my underwriters from my office, but I'm not in the office anymore, so they're a phone call away when I need them. But yeah, 26 days average for me, but the average national lender, like if you go to Chase, Wells Fargo, Quicken Loans, it might take you 45 to 60 days. Okay, good information. Refinance takes a little bit longer, mainly because refinance is looked at as not a high priority. It's only one party instead of a buyer and seller time period that you got to get to. So refinance takes anywhere from 45 to 60 days. Awesome.
Mike, you have been very informative. I hope everybody enjoyed Mike. He has a lot of knowledge there. Pick his brain. Let's get some business over to him so then y'all can come back to me. I love real estate. And we can get a house. I mean, second home, first-time buyers. You know, we're here to try to help you and educate you. And Mike is a lot like me. Let us help you. Tell us, let's open up and let's talk like we're family. And that way we really, really help you. And I think that's like when I talked to Mike and I were just talking, I'm like, I feel like I know this man. I'm like, yeah, okay. So I'm glad. Thank you, Mike, for your time. It's far on a Friday night. And thank you, everybody that joined me. If y'all have any questions or anything, please contact me as well. My number's 214-597-8465. Y'all all know that. And you know, y'all can text me anytime that you have any questions or concerns. So hopefully we'll do something else again like this soon. So enjoy the rest of your day. Thank you, Mike. And Mike, I will send you a recording.
All right, thank you.
Have a happy holiday. Stay safe.
Same to you.
Love your family. Happy New Year.
Happy New Year.
Thank you.
Bye-bye.
All right,